Alison, you know this stuff. Can you sort this out for us?
So looking so far, equities trading a beat. That's
Yep.
right. That's a positive since we saw a miss. I'm just looking at the FIC numbers now, which look light. I'm not sure if I'm looking at the
It must have been light because honestly,
right number,
if it was
1.47 versus 1.58. So I guess we're going to want to hear more about that. Obviously, the equities trading, we're going to want to hear a little bit more about what's going on there. Is there some kind of a mixed impact? We heard from Citi yesterday that really a lot of their strength came from corporate clients and derivatives. We wouldn't expect the same thing from Goldman.
So, Mark, come on in here because we saw this in other firms as well, that fixed income currencies and commodities trading was lower, and it talked about a certain volatility picture as well as EMEA. And I'm wondering, from your perspective on the ground with trading, what led to the lower volumes that have led to lower revenues at the big banks?
So one chart and tool that I like to talk about a lot is if you look at the geopolitical uncertainty indicator, the Baker-Bloom-Davis, there is a very sharp negative correlation with FX volatility. And so I think it's counterintuitive, but I think what you might be seeing anecdotally from desks based on kind of think about this framework is the more geopolitical uncertainty you have, the less volatility you're getting in markets. Largely because a lot of the things that are happening, whether it be Brexit, Trump-China trade escalation, if you think about other geopolitical events, a lot of these things are binary. They're very hard to price. They're up or down. And so basically your ability to manage risk on a lot of these events that continue to kind of keep moving over and over, what it's doing, I think it's having a negative impact on volatility. So I think that's probably something that's feeding through on the macro side that's making it more challenging for trading desks, largely because I think it's leading to lower volumes because you have less volatility, largely because people are there's just much less activity.
I want to come back for a moment to the earnings per share overall. The earnings per share were $5.81 versus $5.98 last year. That's a year-over-year comparison. Compared to estimate, actually, it beat estimates, $5.81 versus $4.93, which may be accounting for why we're seeing the shares now up almost 0.5% in the pre-market trading. At the same time, Alison, I'm getting from Pete Diateras here that their FIC was actually off 13%,
right,
and their equities were up 6.3%.
Right, and I think, we have a significant beat. Whenever we get a significant beat at Goldman, we look at their investing and lending segment. So that almost doubled sequentially, up 82% on the equities line of things. The overall number up 38% sequentially, up nicely year over year. And so that's where they record gains from their equity investments, also where they're doing more on the lending side. So again, to your point, we're going to want to hear more about sort of where they missed in FIC. But on the investment banking side, very strong M&A. And in fact, the expectation were across the peers to expect declines. In fact, we saw that was a miss yesterday at Citi, and Goldman doing much better there. If you look over time, it's always Goldman, Morgan Stanley, and JP Morgan generally at the top. But Goldman's fees tend to be much bigger than the other companies, and that really is just from getting leading roles on deals.